In the quiet hours, when markets are supposed to slow down, silver did not drift. It dropped. Not after breaking news, not after an economic warning, and not after a global shock. It fell when few were watching, when liquidity was thin, and when prices are easiest to move. Charts showed speed but offered no reason. Losses appeared without explanation. While analysts in the West searched for excuses, a signal quietly emerged from Shanghai. Short, technical, and deeply unsettling. When an exchange steps in without noise, it is not reacting to volatility. It is responding to pressure. This was never only about silver. It was about how prices are pushed, who controls the exit, and who is left exposed. The real question was not why silver fell, but who needed it to fall and what this move was preparing for. They had watched markets long enough to recognize patterns. Prices rise on demand and fall on fear. Sometimes they move on news, sometimes on data. But this move followed none of those paths. Silver fell fast. It did not slide lower over several days, did not respond to a major announcement, and did not follow a visible change in fundamentals. It dropped sharply in a narrow window during thin trading hours, when participation was low and resistance was weak. For experienced observers, this detail mattered more than the size of the move itself. Thin liquidity environments are fragile. When fewer buyers and sellers are present, prices can be moved with less effort, and even limited selling pressure can create an outsized effect. This was not speculation. It was structure. They understood the difference between normal price discovery and mechanical price movement. Normal discovery reflects many participants acting freely, while mechanical movement reflects systems reacting automatically. This event showed signs of the latter. There was no sudden collapse in industrial demand, no disruption in mine supply, and no global emergency announced at that hour. Yet the paper price of silver behaved. It only requires precision. From a distance, it appears chaotic. From inside the system, it is procedural. Those who manage capital professionally understand that timing reveals intent. Structure reveals advantage. And this move was precisely timed. It arrived when participation was low. It targeted levels heavy with leverage. It unfolded without resistance. This raised a necessary question. If this was not driven by new information, then it was driven by positioning. Markets do not move like this by accident. Someone acts first, someone benefits, someone absorbs the loss. History offers context. In past episodes where silver dropped suddenly without clear cause, regulatory actions often followed quietly. Not public accusations, not press conferences, but internal notices, rule enforcement, and account restrictions. Such actions rarely appear unless limits have been crossed. At this stage, Western markets remained silent. Analysts debated narratives. Commentators searched for reasons. But the absence of explanation was itself informative, because when usual explanations fail, structure becomes the answer. What mattered now was not the price level, it was the signal. And signals, when ignored, tend to return with greater force. They were still arguing in the West. Some blamed algorithms, some blamed profit-taking, some blamed healthy correction. But none of those explanations addressed the timing, and none explained the silence. Because when a market move is truly normal, institutions speak quickly. Banks issue notes. Analysts publish explanations. Media fills the gap. This time, there was hesitation. And hesitation inside financial systems often signals uncertainty, not clarity. While attention remained fixed on Western charts, something quieter happened in the East. Shanghai released a notice. It did not come with dramatic language. It did not accuse anyone by name. It did not appear on television screens. It appeared where serious participants look inside the exchange framework. The notice described multiple groups of accounts under common control. It stated that these accounts exceeded daily trading volume limits in specific contracts. It further explained that these actions breached exchange processing standards. As a result, the accounts were restricted from opening new positions. To a casual observer, this sounded technical. To an experienced market participant, it sounded severe. Exchanges do not restrict accounts lightly. Doing so disrupts liquidity. It risks reputation. It invites scrutiny. Such actions are typically taken only when internal monitoring systems detect behavior that threatens market stability. This was not about a single trader misclicking. This was about coordination. The phrase, "under actual control," mattered most. It implied that separate accounts were acting as one. This is significant because exchanges design volume limits to prevent exactly this type of concentration. When those limits are breached, it suggests deliberate scale. They understood what this meant. Large players had pushed too hard, too fast, too visibly, and Shanghai responded. This response reframed the silver price drop entirely. What previously looked like a sudden market move now appeared connected to enforcement. Not rumor, not speculation, enforcement. The timing was critical. The notice was dated February 5th. The price move unfolded shortly after, during thin global hours. The sequence suggested that the exchange had already identified stress before the wider market noticed the effects. In other words, the price drop was not the beginning of the story, it was the middle. Shanghai's role in global metals markets is often underestimated in the West. Unlike markets dominated by financial derivatives, Shanghai remains closely tied to physical delivery, inventory, and industrial demand. When stress appears there, it usually reflects underlying strain, not surface noise. This difference matters. Western markets are structured to absorb volatility through leverage. Eastern markets are structured to manage continuity through control. When Shanghai intervenes, it is not to influence price direction. It is to protect function. They compared this response to Western norms. In New York or London, similar behavior might trigger investigations that last months. Public action is delayed, language is softened, accountability is dispersed. In Shanghai, intervention is faster and quieter. This does not make one system superior. It makes them different. And in moments of systemic pressure, differences reveal truth. The restriction of accounts suggested that positions had grown too large relative to allowed limits. It implied that risk concentration had exceeded tolerance. When leverage grows too dense, when control becomes too concentrated, intervention follows, often quietly, often after damage has begun. This is why Shanghai's notice mattered more than headlines. It confirmed that the silver price drop was not merely a reaction to sentiment. It was connected to structure, and structure governs outcomes. The market had revealed its mechanics. The exchange had revealed its limits. What remained was to understand how such events repeat, who consistently benefits from them, and why smaller participants are always exposed first. That understanding requires looking directly at institutional playbooks, not intentions, but mechanisms. That examination begins next, with how banks and large institutions use volatility itself as a tool. They rarely explain how it actually works. Banks do not publish manuals on how volatility is created. Institutions do not advertise how risk is transferred. Yet these mechanisms operate every day, quietly, predictably, and with precision. What happened in silver followed a familiar internal pattern. It did not begin with panic. It began with positioning. Large institutions operate inside a framework of leverage. In the silver market, leverage is embedded through futures contracts, options, swaps, and structured products. Each layer adds exposure without adding metal. This structure allows price to move far beyond what physical supply would justify. They understood that leverage creates sensitivity. When prices move slightly, leveraged positions feel it immediately. When prices move quickly, those positions are forced to respond. This is not emotion, it is math. At the center of this system sit stop-loss orders. Stop losses are designed to protect traders from large losses. But when many participants place them at similar levels, they become visible targets. Algorithms detect these clusters. Once price reaches them, selling accelerates automatically. This is where mechanics replace intention. A single wave of aggressive selling can push price into a stop zone. Once triggered, stop losses turn into market orders. These orders do not ask for good prices. They ask for immediate exit. Liquidity thins further. Margin requirements then activate. Traders using borrowed capital must add funds or reduce exposure. Many cannot react fast enough. Their positions are liquidated by force. This creates a cascade. Price falls, stops trigger, margin calls activate, forced selling increases, price falls further. At no point does this require change in the real world. No factory shuts down, no mine collapses, no demand disappears. The movement is internal. Banks and large institutions understand this system deeply. They design strategies around it. Volatility is not something they fear. It is something they use. For them, volatility clears the field. When prices drop sharply, weak hands exit. Over-leveraged participants are removed. Risk is transferred from institutions to those least able to absorb it. Once this process completes, positions can be rebuilt at lower levels. This is why sudden drops often recover quickly. The damage is done during the fall, not the rebound. They also noted the role of timing. Thin trading hours are not accidental. During these periods, order books are shallow, resistance is low, a smaller amount of capital can move price more effectively. This efficiency matters to large players seeking maximum impact with minimal exposure. This does not imply coordination in a legal sense. It implies understanding. Understanding of structure, understanding of behavior, understanding of rules. The silver market is especially vulnerable because of its size. It is large enough to matter, but small enough to move. This makes it ideal for mechanical events. Another layer complicates this further. Rehypothecation. The same collateral can be used multiple times across the system. This creates overlapping claims. When prices fall, these claims are stress tested simultaneously. The weakest links break first. Banks sit higher in the hierarchy. Retail participants sit lower. This hierarchy determines outcomes. When forced liquidation occurs, it is not equal. It is directional. Those with access to capital survive. Those without are removed. This is why repeated price smashes follow similar patterns. From the outside, it looks chaotic. From the inside, it looks procedural. They recognize that the true function of these events is not price discovery. It is position management. Volatility resets the board. It clears leverage. It redistributes risk. It restores control. For entrepreneurs and capital managers, this understanding is critical. Markets are not moral systems. They do not reward fairness. They reward alignment with structure. Those who misunderstand this chase narratives. Those who understand it watch mechanics. Silver's drop was not unique. It was illustrative. It showed how quickly paper claims can unwind. They did not ask how to predict the next move. Serious capital never asks that question. Instead, they ask something more important. How does one survive inside a system that is not neutral? The silver price drop exposed a truth many prefer to ignore. Markets are not level playing fields. They are structured environments where rules, access, and timing decide outcomes long before price moves appear on screens. For entrepreneurs and capital managers, this changes the objective. The goal is not to beat banks. The goal is to avoid becoming liquidity for them. This requires a different mindset. Most participants focus on direction, up or down, bullish or bearish. But direction matters less than structure. A correct prediction made with poor positioning can still lead to loss. An incorrect prediction made with strong structure awareness can survive. They understood that volatility is not random risk. It is a transfer mechanism. When volatility spikes, it transfers risk from those who cannot withstand it to those who can. This is why leverage is dangerous, not because it is always wrong, but because it removes time. Time is the most valuable asset in markets. Banks have time. Large institutions have time. Most individuals do not. This is why forced selling is so powerful. It removes choice. Once choice is gone, outcome is no longer negotiable. Strategic positioning begins with recognizing this asymmetry. One key distinction matters deeply: paper exposure versus direct exposure. Paper instruments offer convenience and leverage. They also introduce counterparty risk, rule changes, margin calls, and forced exits. Physical exposure, while less flexible, removes several layers of dependency. This does not mean one is always better. It means they behave differently under stress. During calm periods, differences are hidden. During stress, they define survival. They also focused on liquidity awareness. Liquidity is not just how easily something trades. It is who controls the exit when everyone wants out at the same time. In thin conditions, liquidity disappears precisely when it is needed most. This is why professional capital avoids concentration, not just in assets, but in timing. Entering crowded trades means sharing exits. Shared exits are fragile exits. They understood that winning against banks does not mean outperforming them. It means refusing to play their game on their terms. Banks thrive on short-term leverage cycles. They thrive on volatility spikes. They thrive on forced reactions. Capital that does not need to react cannot be forced. This is where patience becomes strategy, not virtue. For young entrepreneurs, the lesson extended beyond silver. It applied to all systems where power is centralized and outcomes appear unpredictable from the outside. Those systems reward those who understand incentives. They punish those who trust appearances. Markets send signals long before outcomes arrive. Sudden drops, quiet regulatory actions, and structural interventions are signals. They are not messages meant for the public. They are warnings meant for those who know how to read them. The Shanghai Notice was one such signal. The silver drop was another. Together, they revealed pressure inside the system. Not collapse, not crisis. Pressure. Pressure does not always release immediately. Sometimes it builds, sometimes it shifts location. This is why strategic capital avoids urgency. Urgency benefits those who control timing. They also recognize the importance of optionality. Optionality means having choices when others do not. It means holding positions that do not force action under stress. It means structuring exposure so that volatility creates opportunity, not obligation. This is difficult. It requires discipline. It requires restraint. But it is how capital endures. Silver served as a case study, not because it is unique, but because it is honest. Its market structure exposes mechanics that are hidden elsewhere. When paper claims dominate reality, instability grows. When leverage replaces inventory, fragility increases. When control concentrates, intervention follows. These patterns repeat across assets, sectors, and decades. Those who study them stop reacting. Those who ignore them keep asking why. The final insight was simple. Markets do not reward intelligence alone.